My name is Billy Nash, and I will be presenting on inventory valuation methods today. And now, why have different types of inventory valuation methods? For several reasons. One is that the cost of producing and purchasing any sort of product, for your inventory, it's not going to stay constant throughout the entire life of your company. There will be ups and downs. Prices will change for manufacturing that product, and so that's inflation, deflation, and also one can manipulate the way they might have to, or not manipulate the way they have to pay taxes, but change the way their taxes, how much tax they will have to be paid by what type of method they use. So the three types of methods we have are FIFO, first in, first out, LIFO, last in, first out, and the weighted average cost. And the first one we're going to talk about is FIFO. So FIFO is the most commonly used one, and it follows the actual flow of inventory in and out of a company. So if, for instance, the light blue box comes in first, it's the first one to go out. Dark blue box is last to come in, last one to go out. So that's FIFO, and this will cause the cost of goods sold of your inventory to be reflecting the prices of the most recent products that you have sold or purchased. And the ending inventory then will be valued at the actual cost of what is remaining in inventory. And I'll explain how later. Next we got LIFO. LIFO, last in, first out, and something to note is that this is only allowed in GAAP and not in the IFRS or international accounting. And now this doesn't actually follow the flow of inventory in and out of a manufacturer. So as you can see, the light blue box is the first one in, but it is the last one to go out, and dark blue box is the last one to come in and first one to go out. And so this raises this reflects the cost not of what's currently in the ending inventory balance, but it reflects the cost of the inventory that is oldest in your account. So your net or your inventory value will be lower than what it actually is. And this will cause you to have a lower cost of goods, or a higher cost of goods sold, and a lower net income, in turn reducing your amount of taxes you'd have to pay. And now the last one we have would be the weighted average cost, and this one is kind of a combination of both the two methods. It takes an average of the costs or the goods that you have available to sell, and divides them by the total units, what units you still have available to sell at the end of the accounting period. And it will kind of give you a cost of goods sold and net income in between the two LIFO and FIFO methods. And so we'll do kind of a quick example. So with FIFO, your cost of goods sold will be higher because it'll be